Here's what's coming up on The Retirement Architect with David Reyes, your retirement television.
You can outsave the market in 08 and 2000 if you're piling money into the market to buy low. Once you stop doing that, which is retirement, we have to protect that capital. We have to create income streams that we can't outlive. So first on fees, some annuities, which are called variable annuities, can have higher fees. Fixed annuities, fixed index annuities, which we deal with mostly, are going to have lower fees. Sometimes the fees can be zero.
You are a boutique firm. You are the fiduciary standard, right?
Well, think of just with being unbiased about it. Of course, if an advisor is 25 years old and somebody's 55 years old, the experience level is going to be a difference, right? They can both be fiduciaries, they both could be great, but there's going to be a different experience level, right? It's our tagline, you retire once, we retire every day, and done that for over 2 decades. We use bonds very little in our firm, long-term treasury bonds. And for 2 reasons. Number one is that there's just not a lot of yield on it. And we're in the cash flow business, right, as for our clients. So if you're getting a 1 or 2% yield on a portfolio, of bonds, that's not a lot.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Hi, San Diego, and welcome to this week's show.
Stay tuned. We have 30 minutes of great information just for you.
Don't go anywhere. The show starts right now. Hi, and welcome to this week's Ask the Architect, where you email your questions into us from all over San Diego, and we answer them right here on the show. David, I have some great questions this week, and I'm going to begin with Marcia from Scripps Ranch. She writes, David, I feel like our investments are all over the place. We really don't understand our money. My husband and I are very conservative and are both terrified of getting hit with a big loss like what happened to our assets in 2008. When our assets went down almost $1 million. Where can we put our money today to keep it totally safe besides the bank?
Yeah, Marsh, thanks for the question, and that's a common question. Where can we put in a low interest rate environment, in a risky stock market environment? So we're going to start with the planning first, right? We do our written retirement income plans that we do. We do a stress test of the portfolio. We do a fee analysis, an income plan. So it really starts first with what is the income that's needed. And so, begin with the end in mind, we like to say. So the end is the beginning, which is the cash flow. And so we'll build that foundationally on the most safest assets that you can be invested in. There's principal guaranteed assets you can be in the annuity space and things like that. The real estate we'll use, dividend paying stocks, but we're going to build it based upon the risk profile of the client and the cash flow needs of that client.
I have to imagine that this is one of the first questions that comes out of someone's mouth when you meet them for the first time, like, where are we going to put our money today in this low interest rate environment? My next question is from George in Del Mar, and he writes, David, my wife and I have been listening to your radio show for quite some time, and we just started watching your TV show. It seems like you look at investing differently than how our current financial advisor does. I retired last year, and my investments look the same as they did 5 years ago. I'm concerned the strategy hasn't changed since we retired. Should our strategy change once we retire?
Absolutely. Thanks for the question. Yes, it's different. Again, accumulation and distribution of assets, and you'll hear me talk about the same theme all the time, is that yes, when you're accumulating assets, we're going to have different types of investment strategies. When we're going to the income phase, we have to make some adjustments to the portfolio. And unfortunately, I see this all the time where they have the same portfolio they had, the 60-40 stock bond, whatever it is, and we have to solve for the cash flow first. So if you're looking truly at just the income needs that are needed in retirement and the safety of those assets, that's what's going to determine the portfolio, not the investments themselves. It's like the tail wagging the dog, right? We want to make sure that we build the portfolio based upon what the income needs are, what the risk is that we can handle or tolerate, which is going to be a lot lower when we're spending money in retirement.
So if I'm 65, my portfolio shouldn't look the same as someone who's 35. And a lot of times, right, they're in that they have an accumulation model, David. rather than a preservation and distribution model. Fair statement?
Absolutely, 100%.
My last question is from Sue in San Diego, and she writes, my husband and I are retired and moved to San Diego 2 years ago. We absolutely love it here. We've been working with the same advisor for years, but we think it might be a good time to get a second opinion from somebody in San Diego. We're mainly concerned with reducing our risk and protecting our assets. Do you do that?
Yes. Sue, thanks for the question. And yes, absolutely, we do that. Our clients are conservative by nature because, again, they've already kind of won the game. They've accumulated their assets. They've done a good job of managing those investments and saving those assets. I say most clients aren't great investors that have money in retirement. They're great savers, right? Because you can outsave the market in 08 and 2000 if you're piling money into the market to buy low. Once you stop doing that, which is retirement, we have to protect that capital. We have to create income streams that we can't outlive. And so absolutely, it's something that we do as a firm, and it's exactly what we do. All we've done for 27 years is retirement income planning, which is key.
You know, and I'll go one step further. There are other things, other questions you should ask, right? Because if you move from another state, maybe the will needs updating. Maybe so there's probably, Sue, a lot of things that you should be looking into when you look for a new advisor. David, thank you so much. If you want more information about anything we spoke about here today, hey, give us a call in the office or go to our website. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Are you unleashing the possibilities of your assets in retirement? Hi, I'm David Reyes with Reyes Financial Architecture. As a retirement and investment advisory firm here in San Diego, we've helped countless retirees and pre-retirees create a cohesive plan to maximize their assets and, most importantly, their cash flow in retirement. Call 866-REYES-PLAN right now to schedule a complimentary second opinion review. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Welcome back, San Diego, to the program. We're here on AM 600 for The Retirement Architect with David Reyes. I've got him sitting here with me right now. David, we've got a great topic. Hey, before I get into that, I got to let everyone know, you're a best-selling author, you're a TV person, you're all over the place, on radio, on TV. Hey, I've got a really important topic today. We talk about this a lot right now, and it's a really important topic this year, and that's interest rates and bonds. Because you know, because you've talked about it, and we've talked about it so much, that this might not be the greatest time in the world for bonds in the context of what bonds are supposed to do. That safety piece of the portfolio, that conservative piece of the portfolio. David, maybe not the case right now.
Yeah, I mean, it's tough times for bonds. It's one of the worst bond markets we've had in about 40 years. I mean, it's pretty serious. I mean, you've had stocks and bonds tracking down together, and so it's a problem. And most firms are going to be using bonds as a risk mitigator. I mean, traditionally it works. So this is an outlier, but it's not unexpected, quite honestly. We use bonds very little in our firm, long-term treasury bonds. And for two reasons. Number one is that there's just not a lot of yield on it. And we're in the cash flow business, right, as for our clients. So if you're getting a 1 or 2% yield on a portfolio, of bonds, that's not a lot. And especially if inflation running in, the high single or double digits, you actually have a negative rate of return, right?
Yeah,
right
and I'll go one step further. If I'm getting that small a return, and there's risk involved,
and you're losing money. You are losing money.
There are other things that can get you a very low return that have no risk, right? Or I should say marginal risk. Everything's got some risk involved with it, right?
Yeah, exactly. I mean, right now, the only bond you want to own is a bill, which is actually like a 3 to 6 month treasury bill, because the volatility is like zero. So we'll use that as almost a cash proxy, right? But the fact is, so call it cash, basically. I'd rather own cash as a diversifier right now, or really ultra short-term bonds, than own anything that has any duration, meaning any length of 5, 10, those have been really, really hammered. 20-year bonds have gotten specifically, they've been down as much as 20% this year. So, it's a problem. And unfortunately, when you've had this kind of the Titanic of the bond market, which is the largest market out there besides the currency markets, and it takes a long time for these things to occur. So this is a generational type of movement that we've had in the bond market. And a lot of people are getting really punished. I mean, you see clients that are, the average client coming to me is that, they're down double digits and they're like half stock, half bond. And they think they're safe, and now they're wondering, hey, what's going on? And most of the firms that we compete against, I mean, that's just what they do.
Yeah, so I want to talk about the fundamentals of what would take a bond down. There's really two players. One is rising interest rates, And then also, let's talk about inflation and how that might also impact bond rates.
Yeah, so they go hand in hand. So right now the Federal Reserve is raising interest rates. So when that happens, of course, rates go up, bonds go down. There's an inverse relationship between stocks and bonds. Think of it this way: if you owned a 1% bond mark and rates go to 2%, your 1% bond is going to be discounted. Because how bonds work is they're a cash flow vehicle, so they'll equalize the cash flows. So to equal the cash flows, we have to discount your 1% bond if I'm going to buy it from you, because I got to buy it at a discount to have the same cash flow.
1%.
Yeah, exactly. But every 1% movement in a 10-year Treasury bond is a 10% loss in the portfolio.
So is it safe to say right now, I hate to use the term think twice, but maybe, again, in the context of what they're supposed to do, be that safer portion of your portfolio, maybe bonds, and I'll throw bond funds in there too, because we should probably talk about both in the same breath, look into another asset class possibly.
Yeah, it's like anything else though. Unless you're dealing with that proactively, it's almost like it's too late. It's like getting car insurance after you get a car wreck. You know what I mean? It's people are already hurt by it. And it's not funny. The ironic part is, so now we're starting to look at bonds to buy bonds because they're more attractive now when you can get maybe high 2s, low 3% rates. Now they become more attractive.
Do you see that trend will keep going? I know you don't have a crystal ball. We're not going to prognosticate.
That's a good question, though. I'll tell you the limitations on it. When you have a $30 trillion budget deficit, which we have, okay, you can't have interest rates go to 5, 6, 7, 8, 9, 10% because it's an expense of the federal government, right? So there's going to be a cap. And if I had you press me on it, I would say probably in the 3 to 3.5% range on the what's called the federal funds rate, which is short-term Treasury or short-term interest rates. So you probably have there's probably some more room to go, but I don't think a lot more. So if you can get a 3% bond now that's kind of real money now. Especially if you can buy municipal bonds, maybe tax-free municipal bonds. We're starting to look at now where I don't have to pay taxes. I can get a 3% yield, which if you're in a high tax bracket, that may equal a 4 or 5% yield.
Hey, let's talk about that for a second because yellow flag, because if a municipal bond potentially, right? How do you know? I mean, clearly they have ratings, right?
Yeah, absolutely.
But what would be something that you would be looking for as far as a municipal bond is concerned? And I'll just be general, if you will, or I know you tend to be specific.
Yeah, that's a whole topic. We could do a whole show on that. But quite honestly, you got to be careful with municipal bonds too. I mean, I live in the great state of California. Tongue in cheek a little bit, right? I love the sunshine, but past that it's a little tough, right? But the fact is that Orange County went bankrupt. You know what I mean? Municipality. Right. So you have to be careful. Absolutely. So yeah, you want highly rated bonds. There's certain criteria you want to look for. But the fact is, I'm just in the fact of, without going down the rabbit hole of that conversation, is that you want highly rated bonds. Number one, if you live in California, you like to have California bonds because they're both state and federal. It can be state and federal tax exempt. It depends on the type of bond you own, or state tax free. So the fact is, you want to make sure that that you check out the type of utility that you're owning or whatever that is. So there's a whole, again, that's actually a good segue to another topic another time. Because I am going to start talking about municipal bonds as a potential for my higher end net worth clients that are in high tax brackets. Most of the last thing I'll say, most clients that are the average person who's maybe getting $10,000 a year from their, or $10,000 a month from their portfolio, they're in a 15 to 20% bracket. So the benefit of municipal bond relative to somebody's in a 50% bracket is a lot different. So the average client is a municipal bond. It's not adding that much value, right? So Treasury bonds would be a better place. So anyway, that's a whole nother topic. That's a great topic. Actually,
we're going to write that one down for another show here. David.
We need to do that.
Hey, thanks so much. You're listening to The Retirement Architect here on AM 600. And listen, if you'd like to meet with David and get a complimentary second opinion, man, it's so easy. Just pick up the phone right now. 866-REYES-PLAN. That's 866-REYES-PLAN, or go to reyesplan.com. In San Diego, don't you go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan. Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Hi, and welcome to this week's Retirement True or False. David, I have some great questions for San Diego. You ready?
Ready.
Question number one. All financial advisors are created equal, true or false? I just chuckle saying it.
I know.
Okay,
False.
It's a total chuckle.
Yeah, I guess I don't know if I wish it was that way, but it's just not. And there's just dramatic differences. I mean, the difference that I see just doing this for a long time is that you have advisors that are really asset accumulator advisors, asset allocators, right? So here's how much stock, here's how much bond. Then there's advisors that are really dealing more with the retirement income planning side of it. It's just a totally different perspective. I always tell clients, I promise you one thing, you come in to see me in our second opinions, you're gonna learn stuff you had no idea that you knew that was possible. And just because when you look at the money differently, we're gonna be we want the money to be useful. Right? It has to do a job. The job is to produce income for the rest of our lives. So that's just a different mentality than somebody who's just saying, hey, here's the great pie chart, and here's the portfolio, and you're this much stock, this much bond, and if it crashes, don't worry, it'll come back, all the things that you hear. And the fact is that most people want to have a higher level of advice when it comes to that, especially in retirement.
George Carlin tells a great joke, and it is, somewhere in the world is the worst doctor, but that's not the funny part. Someone has an appointment with him tomorrow.
Yes.
So I would equate that to the advisor world as well. Hey, listen, you're almost 30 years in financial services, right? You're not the same advisor you were in the first 5 years. You have all of this experience that goes into that. And, all of these strategies that you put together, you've seen success. You have success. You have scenario after scenario after scenario, and we talked about that earlier. So, if someone's looking for that advisor that has the experience to help them, in particular, higher net worth, maybe some, you're a business owner, you've got these interesting pieces here that it's not just another advisor, right? And I'm a strong believer that not all advisors are created equal. And we've spent a lot of time in previous shows talking about fiduciary standard, suitability standard, and I won't get into that today, but you are a boutique firm. You are the fiduciary standard, right?
Well, think of just with being unbiased about it. Of course, if an advisor is 25 years old and somebody's 55 years old, the experience level is going to be different, right? They can both be fiduciaries, they both could be great, but there's going to be a different experience level, right? It's our tagline, you retire once, we retire every day, and done that for over 2 decades. So you get comfortable with saying, this is what we're going to do, and I'm okay with that, right? And a client is going to hire you based upon the confidence they have in you. So, that, yes, over time, you reminded me almost 30 years, I don't feel old. But and nobody said that yet. You're the first person to say that, actually. That's a true statement. Yeah. That is true, actually. But
because you got started when you were 12, right?
Yeah, right, exactly. But no, young. But the fact is that there's a massive difference, good and not even good and bad, just from a practical standpoint. Right. What have they done did they work for Wells Fargo, for a big bank for a long time, and that they did X, Y, Z. The difference is as a firm, all I've ever done is retirement income planning. And so hopefully you do get better at that over time. I'm a much better advisor today than I was 10, 20 years ago, 5 years ago, last year hopefully. So we want to be better. And that better usually means reducing risk, creating more income, right? Creating more safe income. And so being better at mitigating taxes, being better maybe at some estate planning techniques. And things change, laws change, life changes. So, look what's happening today in this world. I mean, with the Ukraine war, with inflation, those are all curveballs that are coming at you have to adapt portfolios to. And a lot of times, though, I see client portfolios and there's nothing that's different when the whole world has changed. Bonds being in particular one big piece.
David, I have to say something. You and I had dinner last night. And, I work with advisors all across the country and interview them. And I was utterly intrigued on all these wonderful new strategies that you brought to my attention. And I thought to myself, this advisor is on top of what's happening. You're staying current, you're staying educated, you're reading all of the mandatory, essential reading that needs to take place with a financial advisor so that you can genuinely provide for your clients the true fiduciary standard, the best of the best. That's what's available today. Question 2.
Yep.
If you have already retired, then it's too late to get a second opinion about your portfolio. True or false?
I would say false, and I actually say more than false is that to second that is that it's almost more important. Because think about it, you're already retired, you're already taking income from your portfolio. What if you're like way on the wrong track? What if you're overspending or your investments are not doing so well? The fact is it's even more important when you're retired, I would say, because at least if you haven't retired yet and you're going through this process, you can adjust more. But if you're already spending down assets, then I think it's even more important.
Yeah, I mean, there should never be, I shouldn't get a second opinion about anything.
Never.
I don't care if I'm buying a car or I have a bad knee, or in this case, probably one of the single most biggest decisions you'll ever make is your retirement planning, your nest egg, and how it's being treated. Of course, get that second opinion. Yeah. A professional second set of eyes. I got a little crazy there. Oh yeah, you have to do that. Right. But it is utterly important for that second opinion. My last question. Taxes will not go up in the future. True or false?
I don't know. You can answer this one. I don't know.
I'm going to do it. False,
True
baby.
Or false? True or false? No.
False.
Well, I was just reading an article coming into today, another one, and it was talking about, so tax can be in different forms. We live in the great state of California, the Sunshine State, the Sunshine Tax. They just happen to be raising the gas tax over 5% in July. Right? Governor Newsom was talking about not doing that because of what's going on. But of course, when you run a state like California is running to the ground, you need every cent you can get. So they decided against that, shockingly. So taxes have many forms. Sales tax, of course. Gas tax. Look at right now with gas prices $6, $7 sometimes in California. That's a problem. So yeah, right now we have a $30 trillion budget deficit, $30 trillion. Think about this for a minute. We had a budget surplus at one point in time, right?
Yeah,
in the 90s, right? In the 90s.
It's hard to believe that.
If we had a budget surplus of $500 billion a year, right? It would take 60 years to balance the budget. Think about that. Wrap your head around that one for a minute.
Yeah.
So do you think that's ever going to happen? Never. So what that means is higher taxes, right? Lower quality of life, potential more inflation down the road as well. There's all these other unintended consequences to that are not fun to think about, quite honestly, as an advisor, but it's just where we've put ourselves.
So I'm going to bring up one piece that might have some sort of positive implication, and that's that taxes are at historic lows right now if I'm going to take
They are.
Federal taxes. Maybe now is the time for some people to consider Roth conversion.
Yes.
Right? Because these low taxes are going to go up. It's going to sunset. You have a limited window to investigate whether or not doing a Roth, which for some people is going to be brilliant, others maybe doesn't make sense,
Exactly.
right? So this is another reason to have a second set of eyes look over your portfolio. Fair statement?
Yeah, I'm glad you brought that up. We're very aggressive with Roth conversion. If you don't know what a Roth conversion is, basically taking a taxable IRA, a traditional IRA, and moving it to a tax-free account so it grows tax-free and take distributions tax-free. Now, there's a price to pay for that. You're going to pay the taxes today. So what we're going to do is methodically do, if it makes sense, or it doesn't make a lot of sense, if somebody's in a 50% tax bracket today and we're rolling over that money at 50%, it doesn't make any sense, right? Because we're just paying money, we're losing money today. Right? But if somebody's in a 15, 20% bracket, we're going to look at ways to methodically have a tax budget and start moving some money over. In a perfect world, I'd like to have half my clients have money in a taxable IRA and half their money in a tax-free IRA. So if somebody had $2 million, I'd like to have $1 million tax-free and $1 million taxable. And that's what I look for.
I like those two numbers.
You do?
Tax-free?
There you go.
Million
See?
taxable.
That's what I want to do.
David, thank you so much. If you want more information about anything we spoke about today, even more important, if you'd like a complimentary second opinion, give us a call in the office right now, 866-REYES-PLAN, or visit us at our website at reyesplan.com. And don't go anywhere. We'll be right back.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
Now more than ever, it's vitally important to review your current retirement plan and get an educated second opinion. Hi, I'm David Reyes, and for many retirees and pre-retirees, this is a very confusing time. As a family-owned business right here in San Diego, we have educated hundreds of families on how to retire with confidence in all market conditions. So let us help you. Give us a call at 866-REYES-PLAN for a complimentary second opinion. And remember, you retire once, we retire every day.
You're watching The Retirement Architect with David Reyes, San Diego's retirement television.
This week I want to talk about annuities, yes or no. Annuities are kind of a hot topic lately and also very controversial. I've dealt with annuities as a firm for over 2 decades, and we used to do a workshop called The Good, the Bad, and the Ugly. So there's definitely spots in people's portfolio for annuities, and the reason being is that they're one of the only investment classes, asset classes, that we can get guaranteed principal or we can get guaranteed lifetime income. So some of the issues that we deal with annuities are fees, principal protection, guaranteed income. So first on fees, some annuities, which are called variable annuities, can have higher fees. Fixed annuities, fixed index annuities, which we deal with mostly, are going to have lower fees. Sometimes the fees can be zero. Average fees or more in the 1% range if you want an income rider, but also we deal with issues of principal protection, guaranteed income. So one of the benefits is if you get guaranteed income, which is hard to do, think of a pension, think of Social Security. So one of the reasons we'll use these for clients is if they want to have predictable guaranteed lifetime income, those are one of the benefits of an annuity. So think of, again, a pension plan, a private pension. Long-term care or death benefits. In a lot of cases, we can actually buy annuities that will allow us to also have long-term care benefits. So let's say, for instance, you have the investment, you don't need it, but your spouse or you need long-term care benefits. We now can use that for long-term care. Liquidity. One of the biggest issues I hear for people that are uneducated about annuities is that, David, well, it's not liquid. I can't get to my money. It's not true with the annuities that we use. Typically, you can get, now if you take all the annuity in a lump sum, you're going to pay surrender charges. But typically, you can take out up to 10% with most contracts penalty-free per year. How we deal with the liquidity issue is we're going to make sure, let's say half our portfolio was in annuities, the other half we want to make sure is in fully liquid accounts. So we're going to deal with a liquidity issue more from a portfolio design standpoint than the actual annuity. But annuities can have liquidity options with them. Reasonable returns is a big one. What's an expected return for a typical fixed index annuity? I tell clients around 3 to 5%. Okay, you're not going to earn 20%, 30% like the stock market, but the benefit is you can reduce risk, eliminate risk on the return side, get a reasonable rate of return. Think of like a bond alternative. Right now, bonds are paying around, let's say, 2%. If I can get 3 to 5% and have some principal protection, that may be a better option for some of my assets. Long or short-term annuities. So most annuity contracts are going to have some type of surrender period or contract period. Typically, you're talking 7 to 10 years. Most of the contracts that I see are going to be in that time frame. So a longer-term contract, yes, it's longer term. The difference is you're typically going to get higher benefits if you do longer term contracts. The benefits can be, better death benefits, higher potential rates of return. The benefit of maybe a lower term contract is, again, it's less term. You have less time in the contract. You can get out of the contract sooner, but you are going to give up some benefits. Typically, it comes in the form of potential rates of return. If you have any questions about anything we've talked about today, please reach out to us or go to our website.
You're watching The Retirement Architect with David Reyes, San Diego's Retirement Television.
Thanks so much for watching this week's show.
And if you want more information about anything we spoke about here today, give us a call in the office or go to our website.
And remember, you retire once, we retire every day.